You're on.
Sure. So, I think the reason why I believe gold is still in a long secular trend is threefold. So the first is
Long secular bull or bear
a
trend?
bull trend.
Okay, you have to be specific.
Sure. So the first reason is um, we have negative real rates around the world, and when you have negative rates around the world, the carrying cost and opportunity cost of holding gold, it doesn't exist. So to give you an example, you're in Russia, and the inflation rate is 8%. The overnight savings rate is 5.5%. So you put your money in the bank, you get 5.5%, but inflation is 8%. You're actually losing 3.5% of your money every year by just keeping it in a bank. And you have that problem in China and India and pretty much in all the emerging markets where inflation is growing and you're not getting return on your bank. You're actually losing your money. So in the U.S., where you can't get any interest rate in the bank now, and inflation is 2, 3, whatever it ends up becoming, you're actually losing the value of your money every single year. And when you have markets like that, people look to move to the asset that is in shorter supply, and so that creates a natural trend to move towards gold. And when you have that around the world, it just creates a confluence that I think will continue. So that's kind of the first thing when you look at it is people usually say when gold does well, it does well in environments when rates are very, very low. And in today's world, they're actually negative. The second thing I believe in, and this is probably my strongest point, is in the last 25, 30 years, the stock of paper money has increased 100-fold. So the amount of paper currency that's been in circulation has multiplied by 100. And by that alone, I feel that all real assets should increase in value because there's just more currency out there. If you think about it, 25 years ago, there were 3 or 4 countries that could print their own currency. Today, there's 25 of them that can do that. The Czech Republic can print their own currency. We didn't have that now. 10 years ago, the Chinese central bank was not barely an economic entity. Now it's a powerhouse. And so when you have so many large countries now that can print their own currency, it will lead to the inflation of these asset prices because there's just so much more dollars or currency in the world today.
Let me ask 2 questions
Sure.
based upon your commentary. If the volume of paper currencies have increased so much, you state that real assets should follow suit. Am I
Particularly
correct?
gold, but yeah.
Okay. Real estate assets are doing the opposite.
Well,
How do you reconcile
yeah,
that?
sure. So I think it's different. So commodities. When I say real estate, I'm usually talking about commodities. I separate real estate out. Real estate, I think the propagation of paper money led to a bubble in real estate, so that we've seen come down. But the real assets like oil, other commodities, particularly safe haven assets like gold, will accumulate because people will see that money's being printed everywhere. One of the things when we were starting this business, the charts we used to always look at was the M2 chart. When we saw the amount of money that had been printed in the last few years in the United States, it was literally like this. That's when got the idea of why don't I start investing in gold, and then this business kind of came out of that. And so I think at times when people look at financial assets and where they want to put their money, they'll always go to the rare asset. And right now that's gold because other real assets aren't there yet. But that's why I think you'll see other commodities do well too. But we believe particularly gold is the asset people will move towards.
Okay. It sounds like you are a believer in historical correlations. Higher interest rates, higher inflation, gold, real estate, etc.
Yeah.
Okay, real estate is broken. It's from one, depending on how you look at it. I don't believe it has, but this is not my interview, so I'm not going to go into that
Sure.
right now. But from certain perspectives, real estate is broken. Its correlation. We have record low real interest rates. You
Yep.
have inflation. Theoretically, real estate's one of the best inflation hedges, and it's highly sensitive to low rates.
Yeah.
You have both of those, and real estate's in dumps. If that correlation could be broken, why can't the correlation, assuming it is,
Yeah.
let's make the assumption it is.
It absolutely can. I think what's a little bit different now is there's never been a time when the currency has increased by 100-fold. That's an increase that's off the charts.
Right.
And I'm with you on the real estate that I think it still needs to correct more before it can ever start growing again. And when that happens, you'll see that happen. The third point about gold that I think is kind of fascinating for me is emerging market demand, and I think that goes in 2 places. The emerging markets we have in today's world are interestingly countries that already purchase gold. So India, China, even Russia, Brazil, gold is part of their culture. People invest in gold and keep savings in gold. As the wealth in those countries grow, just the notional amount of gold buying will increase because they have more wealth to spend on gold. So I think that's a very positive secular trend where in just the first half of this year, 50% of the demand of gold came from India and China. The second aspect, which I think is even more telling, is the central bank buying. So for the last up until the last couple of years, central banks have always been net sellers of gold, been selling their gold, selling their gold. The British central bank sold half their gold when gold was in $200 or $300.
That doesn't concern you?
Huh? I think it's
If,
switched.
if you do an inverse chart of central bank buying
Yeah.
and you traded against it, you'd be quite the wealthy person. So when central banks start buying,
it concerns me a little bit, but I look at it a little bit differently. I don't look at them actually timing the market. I look at the actual. So the British government was trying to time it, right? All the other firms are trying to time it. I don't look at it that. I look at it as, if you look at the United States, 70+% of our reserves are believed to be in physical gold in Fort Knox. Same with France. Most developed countries, most of our reserves are held in physical gold. You look at India, China, Russia, it's less than 5%. And I think if you talked to, you were able to get all the central bankers in the world and said, do you want to keep buying dollars? You want to buy other assets? They're going to apply more of their sovereign wealth to gold. And I think you'll see China, Russia, India, China keep allocating more towards physical gold, particularly because it's something different than the dollar and the euro. It's something that they'll feel a little bit more confident about, even if it's 10%. That's an enormous amount of buying that never existed before. And see, I think that's what I think really propels this market as we go forward, because you didn't have that enormous buying power before, where everything was in U.S. dollars. And I think when you have a huge change like we've had the last few years, that psyche doesn't just change overnight and say, okay, the dollar's great again. I think that sticks with people for a generation, and I think you'll see that move forward.
So in a nutshell, a significant increase in institutional buying power against limited supply,
Right.
creates an increase in price. If I were to just...
Yes. And I think that's not even talking about if inflation ever hits, right?
Right.
One of the things people always ask me, when are you going to get out of this business and know what's going to happen? And I say, when there's a bubble, when during the tech bubble, my doorman owned tech stocks. Everybody owned tech stocks, right? If you took a room of institutional investors and asked how many people you own gold, it's still a very tiny number. And when you ask that question to a room of institutional investors and that's half or 75% of the room says yes, then you're like, it might be time to start selling. But we're barely there. People don't own it yet. Look at all the pension funds. Look at the state retirement funds. Look at the New York State fund count. Nobody owns any gold yet. And so I think the penetration is still very, very, very low.
Okay. Well, there is a significant difference in liquidity between tech stocks and gold.
Correct. And that's, I think, positive for gold, right? Because another...
It's positive for gold, but it also goes against the...
No, it just means there needs to be a price re-rating. I don't think there needs to be more supply. The price just needs to re-rate so that even if I own 1 ounce, that 1 ounce is worth more, and notionally it's a larger percentage.
Okay.
So I think it's just more of a price ratio than supply. But it said another point where in the last bubbles we've had, the tech bubble, supply was almost infinite. Tech stocks were everywhere. Subprime, supply was literally infinite because you could keep bringing a CDO on top of a CDO on top of a CDO. With gold, you don't really run out of stuff. You're limited in your supply. It takes 10 years to get a mine on board. All these mines have been mined. The amount of gold people are taking out of new gold mines is 1.25 grams per ton of rock, and that's going to continue to decline because when you get to a point where the easy deposits are gone. And I think when gold was $1,500, you saw some new mining happen, but the marginal change from $1,500 to $1,700, there's not a lot of change that happens because all the mines that could be mined are being mined now.
Okay. 2 more devil's advocate style questions.
Sure.
And I think this lends much more credibility versus someone to sit here and chilly go on and on.
Sure.
Doing a good job of answering questions, by the way.
Oh, thank you.
Okay, see if I can trip you up. I'll just try a little harder. Right?
Sure.
Interest rates.
Yeah.
I'm going to try and keep my opinion out of the interview, but one thing that seems to be painfully honest that I've been banging on the blog for a couple of years now, interest rates the credit markets have been in a secular bull run for 32 some odd years,
Yes.
the U.S. and abroad. We now see the result of that, the European sovereign debt crisis, the U.S. Ponzi scheme, etc. Rates are going to go up, real and nominal, and they're going to go up in a very volatile fashion. Do you agree?
I don't make predictions. I don't know. I mean, I would have thought things would be a lot different 2 or 3 years ago. So.
Okay, well, let's take a look at, and just walk you through a couple of scenarios, and then I want your opinion on this effect on gold. Take a look at the rates of the sovereign, they're not truly sovereign nations, the EU nations. Greece's short-term and long-term rates.
Yeah.
You're paying triple digits, Italy, Spain, basically anybody who cannot print their own currencies, cannot print their own currency. They've been skyrocketing over the last year. I would have thought this would have been obvious. It was obvious, at least to me, 2 years ago. It's going to follow suit because rates are being artificially suppressed, in my opinion. If I'm correct, and the recent past has shown some credence to the theory. What does that portend for gold?
So it's hard to say. So I think broadly speaking, and I agree with you that should have been a little more obvious, but that's a much longer discussion.
Mm-hmm.
We'll leave. But I think so higher rates are not always good for gold, right? People want to move to the higher yielding asset. But I think in this case, because those rates are signaling enormous fear,
Mm-hmm.
it's actually a positive for gold, and people will move to the safer asset. Particularly what we've seen happening in Europe. In the U.S., you don't know. I mean, it's been odd watching it, right? People would look at the U.S. balance sheet and say, "Hey, you're paying a lot more for U.S. debt," but people look at the dollar as a safe haven, and it's,
For now.
For now, right?
Yeah.
And I don't know how long that goes. Right? It's impossible to time how long that lasts, but it's scary.
Mm-hmm.
It could happen tomorrow. It could be 10 years from now. We don't know. But in that environment, I think it's great for gold because as people start questioning, which will, like you said, for now,
Mm-hmm.
they will find gold or they'll find another store of value. Originally it was $1 in the franc, and then they devalued the franc, and then I think that was great for gold and the dollar. And so I think it is still positive for gold because it just creates enormous fear in the market. I always think if I'm an institutional investor, I don't know if I really want to buy it, take a bet on these high-yielding, sovereign debts because you're betting on political maneuvering. You're not betting on economics fundamentals anymore,
Mm-hmm.
and that's a hard thing to predict. It's very hard to predict, and clearly I'm not an expert on it, but I think it's generally a positive tone.
Okay, because earlier you said that low interest rates, relatively high inflation was bullish for gold.
When I'm talking about rates, I'm talking about real rates to the consumer, to you and me. So when we put our money in the bank, we're getting real rates, which should in turn reflect it through. But what I'm looking at the emerging markets. So it's like the Russia and the China's of the world, where you have inflation, you have negative real rates. So after you take out inflation and take out the rate that you're getting from your bank.
Mm-hmm. Okay. And you don't think there'd be a contagion effect between the EU and China, Russia, Brazil?
It's possible.
Would it be probable, in your opinion? Or you don't know? You don't. I don't know. It's a perfectly good answer. So don't be afraid of it. Trust me.
I really don't know.
Okay, fair enough.
I think the fear of contagion is very high. So I every other day I'm like, wow, if the EU breaks up, things are gonna get crazy.
Mm-hmm.
People are gonna bring out the Deutschmarks again. Then it'll pass on to more China. India's not close to where China is,
Mm-hmm.
and you'll see this kind of snowball effect. I think that the politicians will try to maintain the status quo for a very, very long time. But I think what the entire thing does is it creates gold almost like a currency asset.
Mm-hmm.
Gold should trade like you want to buy dollars, you want to buy gold, you want to buy euro, you want to buy rupees. It should be part of the game. And before it's always been this backwater thing that no one talked about. Now I think it's at the table now, and will be there for a very long time because if there is contagion, it doesn't get fixed. It takes time to figure out how these things get changed. So
contagion in itself is a fix, in my opinion.
Right.
So once it's allowed to play itself out,
if everything fails,
by preventing it from playing out, the game never gets fixed, which is where we are now.
Yeah.
It sounds like you believe gold is going to break its historical correlation.
I do.
You do?
Yeah.
Okay.
Because I also don't think the historical correlation is a proper correlation because when you had fixed gold prices for so long, you had a bunch of built-up demand that was never, it was never been a free market. One of the other interesting things about demand is the last gold bubble, back in the 80s, when we saw the inflation high, there wasn't really access to gold. So companies like us didn't exist. You couldn't buy gold easily.
Mm-hmm.
There wasn't an ETF. So the ETFs are now the third biggest holder of gold in the world. They didn't exist in the 1980s.
Okay.